Welcome to the STR Data Lab.
Hello and welcome to the STR Data Lab. I'm Jamie Lane, Chief Economist at AirDNA, and I'm joined today again by my good friend and colleague, Bram Gallagher. Bram, welcome to the show.
Yeah, thanks for having me, Jamie. Always a good time.
Yeah, so we're sitting here at the beginning of March. This will go out on March 5th or 6th, I think. Bram, did you have on your forecast card that we were going to be in war in Iran at the beginning of March?
No, I did not. We've got a lot of fronts, it seems like, lately. I was telling you earlier, going into the weekend, I heard the big news that Trump wasn't going to use Anthropic, and I was like, wow, that is the big news. That's going to move markets come Monday. But you never want to say that, you've got the latest story because there's new things happening all the time.
Yeah. So we're going to dig in on this episode to AirDNA's 2026 Investor Survey, the first of the kind. But I did want to start, Bram, with just a quick rundown of like maybe what we could expect given wars, especially in the Middle East, because this isn't our first rodeo, and what we typically see out of it for travel and tourism. And I think we've already started to see some impact, and we've seen some volatility in the market. We've seen some impact to oil prices. Oil prices obviously can have a direct impact on travel as it raises the cost of gas, the cost of airlines, and cost of cruises, things like that. We've seen a lot of the major travel companies, airlines, cruises, hotels, OTA, see an impact on their stock values over the past few days. But as you think about war and what we've seen over the past few decades and looking at data, and is there anything that sort of comes to mind on what is typical in terms of what we see in the travel sector?
Well, there's no typical wars, unfortunately, or maybe fortunately. It really is going to depend on the intensity of the conflict. Right now we're only less than a week into this particular one. We've got conflicting reports from Trump or Hegseth, whether it might take 5 or 8 weeks. Of course, we've heard similar things. I think Putin famously said that the operation in Ukraine would last just a few days. And here we are many years later. So there's the immediate effect, the Strait of Hormuz. It's all congested right now. It's going to keep a lot of oil from going through. We did see gas prices increase over the weekend. And I've heard some economists describe high oil prices, high energy prices as sort of a tax on growth. So it has far-reaching implications, but travel in particular, as we go into the summer travel season, gas prices are always sort of an important marker of how willing people are going to be to travel long distances, whether that be in planes or ships or cars. The other thing is that it can have, if it lasts a long period of time, then we can have, longer reaching effects. One, we'll be losing standing in an international community, which we've already seen international visitation drop a bit. That had been kind of a tailwind post-COVID, but now is more and more a headwind, I think. And we're already in sort of difficult fiscal straits as well. So we know that the deficit has gone up and wars are very expensive. Some reports saying that this one's already cost us a few $1 billion, just a couple of days worth. It makes sense, right? We're blowing up, pieces of the most high tech stuff in the world. So, it's expensive, and that can have, longer sort of worrying effects on other types of spending, useful, productive spending, and then the tax receipts. So it's going to depend, I think, a lot on the intensity of the conflict, how long it lasts, and to some degree, the breadth as well. How many people get involved in this? I know that Iran has launched counterattacks against, many hosts of U.S. military bases in the region, maybe trying to broaden the conflict. That could have more global consequences, I guess, as far as economics is concerned.
Yeah, and that was my biggest surprise and biggest sort of difference I think we've seen so far is that, and usually it's in one or two country war, we see the direct impact there. But the way that Iran started just bombing everyone around them, and specifically and Dubai is such a big tourism center in the UAE that we have seen cancellations spike around the region as people look to change their travel plans. They're maybe stuck because essentially we've got an airline ground stop that covers the entire region, and I think there's a lot of worry, and I'm definitely worried. Like, how long is this going to impact travel to the region, even if they're not directly involved in the conflict?
Right. Yeah. In Dubai, I think is the biggest single destination, but there are other destinations even within the Emirates. Abu Dhabi has got some hospitality assets. Saudi Arabia has been making a lot of investment in tourism as of late, including in short-term rentals, which have increased, quadrupled, quintupled, 10 times the amount. Just 5 years, every couple of months, you've got to update the figures. They're growing so rapidly. So this is going to
Yeah.
be concerning for, I think, a lot of the people in the region.
All right. So that's enough war talk. We're here to talk investment. And we have this great new report, which will be linked in the show notes. AirDNA's, I'm going to call it H1, first half 2026 investor survey, because I want to make this a regular thing. And it is our first one. So AirDNA's been around for 10 plus years now, and we've never done a survey specifically sort of focused around the motivations, the concerns, the goals, the issues around short-term rental investing. So if we haven't done it, I suspect this may be the industry's first in terms of a pure investor related survey. What do you think?
I haven't seen anything quite like this for the short-term rental space. No, we've seen a lot of hotel investor surveys. You're going to be going to the 100 conference in a couple of weeks as well. So, you know, it's definitely a well-explored area in other types of hospitality, but short-term rentals, once a little analysis too, I think.
Yeah. So just some facts around the survey. So we sent this survey out. It was completed by almost 650 people, primarily in the U.S., almost entirely in the U.S. About 2/3 of those people are already own or operate one or more short-term rental properties. But what I thought was really important is 1/3 or 34% of those that completed the survey were not yet short-term rental owners or investors. So we did get the view of people looking to come in. And I think that was really fascinating in terms of who and what they are and what they're looking to get out of their short-term rental investment. We did see the vast majority of those that own or operate are individual investors or property managers. So these are those that are owning and operating. And also, the vast majority or about half had one property of those that did. About 40% had 2 to 4. And then another 10 to 15% had more than that. So we're primarily looking at the responses of small independent owner operators and their experience in the space. And then we did get a lot that have more than about a third had 3 to 5 years of experience. About 25% had more than 5 years of experience. So these aren't just new investors that were responding. These are people that have been in the industry for years and have now built a lot of experience in their investing.
Yeah, I think for the first survey, I'm really happy with the number of respondents, and then crucially that we have that really great division, about a third that aren't invested currently, but are thinking about it, and then 2/3 that aren't. That means that we can do cross tabulations, or we can compare those two groups and see even within those two groups how do people differ in their opinions, and how is that going to affect sort of their intentions moving forward. So, especially for a first survey, really, really happy with that.
Yeah, and I think what's going to be exciting is, and now that we've done the first one, so with the first one, we can't really talk about how sentiment toward short-term rental investing has changed. But as we do the second, third, fourth, fifth, sixth, seventh, 10th, 30th survey, and we're going to be able to build a time series of sentiment, of what are the concerns, how is the respondents sort of evolving over time, which I think is going to just add that much more depth to the responses, and be able to look at how respondents are sort of evolving over time.
Yeah, no, it's exciting because we have, looking over at the sort of terabytes of scrape data and all that sort of data that we've got. I had just one thought to myself, and that is we need more. And this is a completely different sort of way of collecting data, and it's many in many aspects qualitative, whereas usually our data is quantitative. So very interesting, and certainly a time series would really tickle my fancy.
Yeah. So I don't necessarily want to start at the beginning of the report. I actually want to start at the end because I feel like it gives a sense of some of the motivation of short-term rental investors today, specifically new ones. And this was something I didn't really have in my head of like what to expect. Maybe maybe it was one of the biggest surprises for me of, and what we asked people was, what was your primary motivation for considering a short-term rental investment? And in talking to people, and I hear tax optimization all the time. I hear wanting to buy into real estate, which is going to appreciate over time and is a way to and build wealth, asset diversification, things like that. And the surprise for me was how overwhelming just income and cash flow is for most new short-term rental investors. I mean, they are wanting to come in and build an alternative income source, and short-term rentals being a cash flow generating asset, is that primary motivation.
Yeah, I was impressed by that too, because I would have thought maybe some of these people are just going to try to flip these homes, just realize maybe property appreciation as maybe sort of their monetary strategy, or something like that. But they're really focused in on the sort of long-term cash flow strength of the travel industry, and it's more of a, I think it's more of, say, a longer term kind of idea, I guess, about sort of what these instruments are, and what they're for, and that's for generating recurring revenue. I also like too that our hedge against inflation, despite having really heavy inflation, and sort of as Jack Cordial from the Cornell Hotel School used to point out, that's sort of been a long held theory about hospitality, is that since you can change the rates so frequently, it may hedge against inflation. But nobody responded that was their intention for diversifying their asset to strengthen against inflation. But yeah, cash flow. So that is the stuff that we're really focused on, which really pleases me as well.
Yeah. The other surprise for new investors for me was, and we asked about their biggest barrier. And when I talk with a lot of first time investors or people thinking about investing, usually the number one response is, man, I just don't have time. Like that this is going to be and way too much effort to find, to manage. But, and maybe it's not a surprise given where we are in the cycle, but the number one response in terms of and biggest barrier was that property prices were too high. Um, we have seen a lot of appreciation, and that's clearly weighing on investor sentiment, even though, and with where property prices are, like 52% of those aspiring investors do plan to actually buy within the next 12 months. So yes, it's a concern, but they still expect to be able to buy within the year. So what do you think's sort of driving that?
It's the biggest hurdle. In other words, it's the biggest hurdle, but it's not insurmountable. I think, well, just the very, very fast run up in prices that we saw post pandemic, 2020 to 2021. Just watching those prices, it really got to eye-watering sort of levels, and it hasn't backed off since then. So I think people are conscious of this when they're looking to invest. They're maybe more conscious of sort of the sale price of the home rather than, say, financing, because I would have thought interest rates must be second if property prices are first, but they're not. They're actually in third. Lack of knowledge and experience is actually a larger hurdle for these first-time buyers rather than interest rates. So I'm thinking that they're looking at the property prices. They've seen maybe their own homes sort of appreciate to again very, very high levels, and they doing the calculation even with sort of interest rates coming down a little bit. Those mortgage payments are still elevated, and then that lack of knowledge and experience. So these are the first-time investors. These are people that aren't sort of introduced into the world. So that is it's fascinating for me to see that it's it's a knowledge barrier that is keeping these people out. Not even economics, not interest rates, or even legal environment or something like that. But it is just the information that they're lacking that keeps a lot of people from investing.
Yeah, and seeing this, it sort of resonated with me with why sort of coaches in the industry seem to do so well, helping people figure out how to invest, how to navigate. And so we work a lot with the likes of like Mike Riley and STR Secrets or Rob Abasalo or Bill Faith, these guys that have really and built their systems around investing, that they do a lot of education within the industry, and that there's so much desire for someone to hold your hand and sort of bring you through the journey. And even if it's like Taylor and John at STR Search, where they're going to find the property for you, they're going to underwrite it, and even do all the work to furnish and any renovation you need to get that unit launched. So soup to nuts, and we will get you invested in your short-term rental, help you launch it, and then you're good to go.
No, exactly. I was lucky enough to be able to sit in on some of that Savvy Realty Summit, and it was great hearing Tyler. They went through a couple calls, how they would talk to first-time investors, and it really a lot of the value that they get from interacting with those clients is that sort of white glove service, is just leading them through every single step. Because there's a lot of things to think about. There's a lot of contingencies. There's lots of different varieties of financing, of how to make this acquisition, how to stage it, where to position it. So, as well as I do, there's a lot of information out there, and there's a lot of options and choices. So, but looking at this chart too, something else that strikes me is that the three biggest barriers to entry, the property prices, the lack of knowledge, and interest rates, all three of those we'll find some relief, I think, coming in this next year. So property prices, they've been stalling a little bit. They had been going up, but they're not going up as quickly anymore. In fact, January we saw very, very low home sales. A lot of that due to the weather. But as inventories grow and time on the market increases, we know that doesn't help prices, but usually the opposite. Interest rates, well, those are getting cut now. Or this new sort of inflationary push from oil prices may throw a little bit of a wrench into it, but we haven't made big adjustments to the forecast yet. We're still expecting to see interest rate cuts resume in the middle of this year. We saw mortgage rates briefly below 6% again. So that was something that Oxford had not forecast that it would do. It's gone back up since then, but it was fun to see it while it lasted. And of course, lack of knowledge, experience with all the new platform improvements at AirDNA, then that one's taken care of, right?
Yeah, our colleague Linda has been putting a lot of effort into the educational aspect around how to use our platform. So hopefully that does help. The last question, and we sort of asked potential investors, was the price point they were looking to invest. So how much capital, combination of your down payment, setup costs, and reserve are you planning to allocate to your first STR purchase? There again, I was surprised on how much it skewed to and really spending and either less than 50,000, which was about 28% of respondents, or between 50 and 100,000, which was another 25% of respondents. So over half of investors are looking to spend $100,000 or less on that first investment, which you think about in the down payment. And so an average short-term rental is being purchased for about $500,000 right now. If you're putting 20% down on it, that's $100,000 right there.
And that's your second home. So no subsidies or anything like that.
Right. And knowing firsthand the cost to furnish, amenitize, and get ready a property. So it does look like, and a lot of investors today are looking at the lower end in terms of the price point for new investments. And maybe that is one of the ways they're dealing with high home values, is sort of adjusting their expectation, or at least searching towards the lower end in terms of property values and how much they're actually be able to invest.
Right. I wish we had a follow-up question. How much sweat equity do you expect on putting into it?
Yeah.
Because you're right. Those, if you're not doing setup costs or setup stuff yourself, if you're not, you got to make the place look really nice, at least as nice as your guests' homes, if not nicer. So, that can take time. It takes a lot of money and effort. Maybe people are underestimating to some extent. We said that lack of experience was certainly a barrier to entry. So it may be the case that, wow, I'm sure that setup cost couldn't be too much. But on the other hand, you're right. More than half of these people are going to be getting into the short-term rental business with less than 100,000 in capital startup. So pretty impressive. There's, I'm trying to think of all the businesses that you could get into, for just $100,000. It's not a whole lot. I mean, you got a hot dog stand maybe on the corner, but there's not a whole lot of businesses that you can start up with that. So it's interesting to me. It's almost like it's a very achievable goal for a lot of people.
Yep. So now maybe we'll pivot a bit in terms of, we've talked about those not yet invested in short-term rentals, and now like the vast majority of people responding to the survey were already investors. So maybe let's talk a little bit about the trends of who's actually buying right now, because we did, and my number one question that I wanted to ask, because I'm so interested in like how this is going to trend over time. But like, and the question was, how likely are you to purchase a new short-term rental property in the next 12 months? We saw about 42% of respondents say they were either likely or very likely to invest. A good number were neutral, sort of sitting in the middle. And a good number, about 40%, were very unlikely or likely. So we saw that sort of bimodal distribution, or maybe even trimodal with the neutral. But this is where we can start to crosstab, right? Of like, in looking at all the components of an experience, existing size, markets, things like that, of who's actually buying. So, and can you give me a sense of what we learned there, and what did you see when you looked at the results?
Yeah. So one is that we do have the sort of pushing out to the extremes. So we always would expect that neutral would be in the middle, but what about hedging your bet with just likely or unlikely? Well, people are not as apt to do that. They're really pushing out. So they've got a lot of certainty. And then, as we were talking about, something that was very heartening is that we saw people that had more properties. As their portfolio increased, the likelihood that they were going to purchase a new STR property in the next 12 months also increased. So, you know, to your point, and we were discussing this just a while back, but if you had bought one property and then said, "Okay, I'm never doing that again," that's a bad sign for the that's a bad sign for the industry. But here, it looks like that even as you go up one property, you've got about 40% of those folks saying that they're going to be purchasing, and then you get about 45% for the people that own 2 to 4, or that host 2 to 4, and then even higher still for the people with 5 to 9. So I think it's the idea that these people are maybe realizing the returns to scale once they've gotten a couple of these under their belt. They've really figured out what works in their area and what works for them. And they can make more strategic and informed acquisitions. So it's giving them the confidence that barrier has been removed. So now it's more like, well, is this paper or not? Is this a good investment? And they can make that comparison as many times as they like, and that increases their likelihood. So that, I think, was really excited to. I was excited to see that. Um, the other thing is that supply growth has been it's been on a bit of a roller coaster from the last 5-6 years. So we have seen really 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 fast growth in say 2022 post that amazing performance we saw in 21. A lot of people rushing in, maybe even some attrition as time went on. Inflation went up, and some of these folks maybe were not the most interested in hospitality, but rather were being a little opportunistic, right? So I think the investment environment that we're going to see over the next year, it's going to speak more towards deliberation, more to this idea that we're going to analyze the investment prospect, from a very, sober and market stable perspective, and that we've got a lot more experienced people that are going to be interested in buying additional properties as well.
Yep. No, that I was gonna be worried if we only saw new and one property investors say that they're the ones willing to continue to buy. The fact that and the more properties you have, the higher probability you are to want to continue to invest tells me that we're seeing positive results in terms of short-term rental investment. And then we also asked, like, how likely are you to sell one or more of your short-term rentals over the next 12 months? That was, I think less than 15% of those that responded. Those already had one. So over 400 respondents were likely to sell. So, in the vast majority, and over 60% saying, or 70% saying that they were unlikely to sell. So that to me says that we're seeing success for investors that are coming in, and that those that have figured it out want to add more.
Yeah, and I skipped right over that question because as soon as I saw that chart, I said, "Well, nobody's selling, so that's good."
Yeah, maybe our friend Amy Nixon should take a look at that one, because she's constantly spewing about and how or Nick Curley, like how people are going to be exiting the space because of the lack of performance.
Well, and maybe to their point, again, we might have seen some of that in 23 or 24, after we saw this huge supply rush, but there's been a lot of discipline since then, a lot of information since then. AirDNA has been at the forefront, but there's been a lot of vendors as well that have other data products and tools that have really helped out people to really formulate strategies. So I think all of that helps reduce sort of this market exit. And of course, performance is picking up, so that's nice too.
Yep. So we also asked existing operators what their top constraints were to buying. And again, we saw some and really interesting results when we sort of look at the underlying data. So it sort of followed an aggregate that, and a lot of what the new investors were saying, that and property prices, demand uncertainty, interest rates were concerns. But what I and really thought was interesting was one for property prices, the more properties you had, the less of a concern property prices actually were. So those more experienced investors are able to find deals that pencil that they can invest in. Um, but also on the concerning one, though, was the thing that there's two things that really became more of a concern as they scaled. The biggest one was regulation. So regulation is something that first-time investors are not really that concerned about, but once you get to 5 to 9 and especially 10 plus, it becomes a really significant concern around regulations coming in and impacting short-term rental investment. And then the second was around demand uncertainty and market saturation, where they have now, in getting to 5 plus properties, have seen the roller coaster ride that has been the past 5 to 6 years, where we've seen more and more markets become saturated, occupancy sort of fall, though most markets are still at or above pre pandemic levels. And that has been a top concern for a lot of investors out there.
Yes. I just would say the one thing about regulations and speaking with operators, I guess once you get to the top, once you have 10 properties, it's pretty likely that you've gotten burned by regulations at some point. Is I think maybe one thing that's driving that. And then once you have personal experience with those regulations, you could realize how important they are and how they can change pretty quickly if we don't have an engaged, group in the local politics that's advocating for short-term rentals. So it's good to see that these experienced hosts are really taking that into consideration, and I'm hoping that they are using that to motivate organization, and again, yeah, political action to prevent onerous regulations. So, working with FIRMA or other organizations. So that's always an interesting one to see, and something that maybe that you're right that if you haven't been in this market, if you haven't gotten burned by changing regulations or getting a big hefty fine for missing regulations, then it's probably not nearly as salient a point. Market saturation, demand uncertainty. Well, that kind of gets back, I guess, to this cash flow idea, right? So that's really what people are really concerned about is that cash flow, and that we have seen a lot of economic uncertainty. Luckily, the economy has been pretty resilient so far, but how many times can we say heightened uncertainty, right? Over the last, people are moving their expectations about what uncertainty they're comfortable with at this point.
Yeah. Are you still cautiously optimistic?
Always. It's the cautiously optimistic science, economics.
Yeah. So another theme in the report, and we talked about it with new investors, was around interest rates and the impact those are having. It was a key sort of theme in our outlook report going into the year. Was we did expect interest rates to come down some, and clearly, interest rates are weighing on people's ability or willingness to invest. And we saw that 73% of respondents, it's impacting their propensity to invest. But as with a lot of these things, like you look below the surface, and we do see that, and for those that said interest rates were impacting their ability to invest, when we then subdivide that between those that are likely to buy or unlikely to buy, there's almost no impact that interest rates have. So investors, I see the interest rates, they say that it's impacting it, but then when we look like, okay, of all you guys that said like you're impacted by interest rates, almost the exact same number of people say they're likely to buy versus unlikely to buy. So yeah, it does seem like there is and more selectivity and greater focus on it, but that interest rates aren't going to be the main decider of if you're willing to invest right now.
Yeah, and this also speaks to one of the later questions where we had different views about the same sort of macroeconomy. So if we knew that rates were unambiguously bad, then you would expect that the people that respond and say they are extremely impacted would by rates would not be buying in this bad rate environment. But it seems like you know people are divided as to whether or not the current rate situation we have is actually good or bad, because you've got this 50-50 split between these people extremely impacted by rates, half of them very unlikely to buy, half of them very likely to buy. So it's very interesting for me to see the people looking at the same macro environment, and some people are saying, well, compared to 2022, these rates are way much higher, and then there's other folks saying, well, compared to about a year ago, they're lower, and they're gone on the downslope. So it is, I think, it is an ambiguous kind of environment, rate environment, and price environment right now, which is better than an unambiguously bad one. But there definitely speaks to a lot of opportunity that remains out there.
Yep. No, I loved how we sort of took the same trends and sort of like spending. And when we asked about the sort of positive, negative effects, like you have, like, if someone's unlikely to invest, they're sort of citing the weak economy and slowing spending. And if they're likely to invest, they're citing strong travel demand and strong consumer spending. So it's and this bifurcated economy that we have of half the people are feeling good, half the people aren't feeling good, maybe starts to explain a lot around and the sort of half and half split of those that are likely to invest versus not. It's not just property prices. It's not just interest rates. It's maybe a general feeling about how they're feeling about the future, and that could very easily probably swing one way or the another as we progress throughout the year.
Yes, and many times, in fact, right? Depending on who you ask.
Or by the end of the week.
Yes, right. Even over the weekend, things can change pretty dramatically. Yeah, the only one that I saw a really significant difference was the inflation in cost. We saw the unlikely investors a little bit more concerned about operating costs, but that makes a lot of sense to me because inflation, whether you think it's mostly behind us or it's still a worry for the future, we're still sort of dealing with those costs playing out. But might be something to dig in a little bit deeper in the future. Future surveys about operating costs. We don't have a whole lot of data on that right now.
Yeah. And then the last two sections of the report to discuss sort of centered around financing and market selection. On the financing side, and I was really interested to understand how people are financing these investments, having gone through an investment of my own. First investment property, used a conventional 30-year fixed rate mortgage, looked at other options. They didn't seem as attractive for me, given that I could get a traditional mortgage and the sort of low interest rates that go along with it. So it was at least it was reassuring to see that other sort of one property first time investors, over half of them also used a conventional 30-year fixed rate mortgage. But again, one of my biggest surprises was in seeing, like, as investors scaled the number of properties under their investment portfolio, the distribution of types of financing really expanded. Of those that are using private financing, hard money, portfolio loans, adjustable rate mortgages, DSCR, or loans. Like, very few people actually use them for their first property. but it goes up to almost more than half once they get to 5 or 10 plus that are using these other alternative forms of financing.
Yeah, and to your point, uh, you know, you got a mortgage, you had the one property. If you've got many properties, well, there's two strategies I guess you could do. You could take a conventional mortgage out on one property and then pay it off, and then move on to the next property and keep sort of leapfrogging like that around. Because if you've got 5 to 9 properties and none of them are paid off, then your income would have to be very high, I guess, to support that kind of mortgage debt. But it seems like, there are other people that aren't doing that sort of leapfrogging strategy. They're comfortable with these sort of different types of leverage and are expanding their portfolio, using leverage, and not just, the one mortgage that we're sort of familiar with. The adjustable rate mortgage, that proportion jumps up so much with the 10 plus properties category, which was really interesting to see. You can get generally lower rates that way. So it's interesting to see too that people with large portfolios are able to absorb different types of risk differently as well. In this case, I guess interest rate risk is not as much of a concern. But yeah, uh, the idea that not only are people confident and likely to invest in the future, but they're also comfortable, doing it on a leverage basis, which is tells me that they have strong confidence that they'll be able to make these payments.
Yep. No, and I guess it also just illuminates to me that, and as I add more properties to my portfolio, like, it does behoove you to get more comfortable, educate yourself on these other forms of financing, how to access the money, what you need to do to qualify, because they can, and if your income sort of runs out for, and debt to income ratios needed for traditional 30-year fixed rate mortgage, that doesn't mean you need to stop investing. It just, and means you can, and need to start to and look elsewhere for types of financing.
Right. And in some cases, when your portfolio becomes large enough, some of these different financing methods may even end up saving you money.
Yeah. So the final section, and this is, I think, a fun one to end on, given that we just did our best places to invest report, is where are people looking to invest today? And no surprise, at least to me, that uh, the top two location types were coastal beach destinations and urban markets. And it's, and typically when I talk to people, like, that's, and they want to and buy a house at the beach, rent it out, or they live in Atlanta and they found a home in their neighborhood that they think they could rent out and it would make a good short-term rental. And it being, and in the city that they're in, like, it feels easy, and it feels like something they could manage themselves. But again, like, you start to look under the surface, in terms of the types of investors, and then what they're investing in. And so here I saw the biggest sort of trend if we sort of cut the location types by years of experience. So there's investors with less than a year, 1 to 2 years, 3 to 5 years, and 6 plus years. Here we see the early stage investors sort of gravitate more towards familiar, and it's the and market they live in, urban city centers that drive the most investment. Easier underwriting exceptions. Also, the coastal markets rank pretty high. Maybe it's and where they and go to the beach every year. But then as investors gain experience, the preferences then begin to shift. And so, sort of midterm investors, 1 to 5 years, increasingly more looking towards outdoor national parks, mountain ski markets, where they and maybe get a more comfortable with the seasonality, operational complexity, hiring a remote team. And then among the most experienced investors, this is where we see, and coastal and mountain markets really dominate. And you see enthusiasm around sort of urban, suburban, college towns, sort of the large and mid-sized cities, really start to collapse. Like it's not investing in your backyard. It's those investors that are seeking durable demand drivers. And I had a really fun post on this on LinkedIn this past week of using our new location scores and how guests are reviewing different properties and using our AI review analysis to find what are those durable demand drivers. Because when you find durable demand, you've got pricing power and it becomes a much more defensible, long term investable market as opposed to what is the easy spot to invest and where are the places that I know, and maybe instead flipping it and where are the places that I think are have the greatest returns or have a demand that I know is going to come back year after year, and that I can really get outsized returns on given my ability to price those properties.
Yeah, I think you've really explained this data really well. That experience, lack of experience being such a big barrier, right? I guess if you are inexperienced, yeah, maybe a house next to yours is the easiest way to do it. And, it's fun too, because you're learning about the whole process at the same time. Now, 6 years plus, there's not a whole lot to be learned, I guess, from renting the house next door. You want to make some money. So, uh, I guess the conversation there is probably very, very pointed, and it really does point again to these demand drivers. Now the urban conundrum is interesting because it's still pretty popular among experienced. I think there's still a lot of it's more popular among the less experienced, but it's still pretty popular among the more experienced. We have seen kind of a resurgence in the supply growth in urban over the last 2 years. They were not very popular right after the pandemic for obvious reasons. People were trying to get away from urbanity at that point, but they've been coming back a little bit. Some cities, well, that regulation, of course, plays a big role, and some cities are doing well. But check to see what the performance is in your area because in some places we're also seeing sort of occupancy struggle a little bit with this new supply coming in. But and then, of course, coastal beach destinations and mountain lake resorts can maybe have the biggest payoff, but I think they do come with a lot of additional complexity, whether it's regulatory stuff or even considerations on the coast, like say flood insurance and other natural disasters that may strike. And we know that has affected short-term rental markets in the past few years. So all things that you really should consider and maybe have some experience under your belt for messing with.
Yeah. So this has been fun. We talked a lot about around the trends of investors. The last one I wanted to leave people with was this is still can be fun. One of I the reasons that we didn't talk about, but is still a very popular one for investing is just lifestyle and personal use. Like this is one of those asset classes that and really lends itself to that. And I know was a big factor in my investment. I know it's a lot in a lot of other people's investments and is something that is maybe unique to short-term rental investing of and you can put together a portfolio. It can be in really cool locations. The ability to use those for yourself, for your friends, for your family to host, to have fun is a neat way that short-term rental investing sort of merges with lifestyle and personal use.
Yeah, finding a home that or a place that you love, and then being able to share that. It sounds like the dream job, and maybe it is.
Yeah. So, and that was a fun data point for me that came out of it. So, Bram, this was a lot of fun. I thank you so much for joining and discussing the report. As I said, the link will be in the show notes, or you can go to the AirDNA homepage and find it. And we'll be back soon to discuss the performance for February and what we're looking at for spring break and the rest of the year, probably next week. So thanks everyone for joining in.